So there's a new retirement system coming to South Africa, and in this video, we're going to break it down for you. Hi, my name is Yolanda. I'm a wealth advisor, and on this platform, I give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. And we're talking about the two-pot retirement system today. And the National Treasury is proposing this two-pot system for retirement savings, which allows members of retirement funds, retirement savings, which allows members of it to access 1/3 of their pension savings once a year in event of an emergency, while preserving the other 2/3 for retirement. The proposal is to split contributions into two pots for all retirement funds, but in practice, members of longer standing retirement funds will have three pots. But before I tell you about that, I want to tell you about Retirement Bootcamp. Since we are back to doing live events, I am hosting Retirement Bootcamp on the 19th of November 2022 in Sandton. In this bootcamp, I will be telling you all about the retirement landscape in South Africa, what retirement products that you can be utilizing, and what other financial mechanisms you can use to retire sweetly in South Africa. And most importantly, I'll be giving you strategy. And know that a retirement product is not a retirement solution. You got to apply strategy to that before you can get the desired result. And I would love for you to join me on the 19th of November. Click the link where you're watching this video and get yourself tickets before they sell out. Early bird tickets are currently available. Make sure you get them before they sell out. So back to the three pots. Firstly, there's the vested pots, where the amount accumulated before the implementation date. So all contributions and growth that are accumulated before the 1st of March 2023, this is the vested pot. And this will have to be valued at the date immediately prior to implementation of this two-part system. Then you're going to have the 1/3 accessible savings pot. And only one withdrawal from the savings pot can be made a year at a minimum of 2,000 rands. All or part of the amount accumulated in the savings pot up to the allowable withdrawal date each year can be taken out. And lastly, we're going to have the 2/3 retirement pot, which is subject to full preservation until retirement. So contributions after the 1st of March 2023 have to be preserved until the retirement date. After studying this for a while and studying it in depthly as I can, a limited amount of information available, I have been able to identify a couple of advantages and disadvantages. The first disadvantage of this is the taxes and paying tax on any amount that you withdraw. So any amounts withdrawn from the savings pot will be included in the member's taxable income for that tax year and is taxed at that relevant marginal rate. So you're effectively canceling off the tax liability that you would have had if you had kept the retirement savings invested. Secondly is the withdrawal limit. Now, only one withdrawal from the savings pot can be made a year at a minimum of 2,000 rands. All or part of the amount accumulated in the savings pot up to the allowable withdrawal date each year can be taken out. Then is the loss of compound returns. Now, remember, when we do invest into a retirement fund, right? Let's say you make a modest contribution of 1,000 rand a month. Right, that 1,000 rand goes into an investment. Now, the asset manager obviously is going to take care of this. And if you're in a bigger company, you'll have some options as to what you invest in. If you're in a smaller company, probably not. But essentially, that asset manager is going to invest. They're going to invest in various funds. Those funds are going to contain things like equities, shareholding, or interest-bearing investments like bonds, money markets, maybe a little bit of gold. I don't know, depending on the fund, right? But things like shares, they pay you dividends. Those dividends will be accumulated to your retirement tax-free. And that's one of the benefits of a retirement savings is you have tax-free growth. And when you withdraw, you're going to lose that tax-free growth. And you're going to lose the compound return as well. Because when you get those dividends, let's say you get 100 rand worth of dividends a year, those dividends go to buy more units into your retirement. And that's the compound return that you're going to be missing. All right. And then there's the financial behavior of South Africans. Reckless spending does not just happen in government, unfortunately. And if we look at the savings rate, and the danger of the individual seeing the retirement savings pot as their only savings pot, and that can be disastrous. South Africa's current savings rate is extremely low by global standards. With gross savings of less than 15% of the GDP in 2019, South Africa has one of the lowest savings rates in the world. This rate is far below the average of 25.1%. And the average of sub-Saharan Africa is 18.8%. And that of middle-income countries, which saved 30.5% of their GDP in 2019. We have a trend of falling savings over the last 40 years, and it seems to be very unique to South Africa. Another thing that's very indicative of the behavior of South Africans is alcohol consumption. I know, how does alcohol relate to retirement, right? But think about it. South Africa's largest liquor producer, Distell, reported revenue growth of 20.8%. That's around 31.1 billion rands at the end of June 2022. The volume rising to 17.6%. Right? So there's also been an increase in volumes of sales. So how is that happening if we are in an economic crunch and the public is supposedly studying? For me, it's an indication of mismanagement of money and not really prioritizing what's important to you. Because we have such a high poverty rate, so many, a good majority of South Africans are receiving grant, they're receiving social aid. The workers are struggling. How is it that alcohol and alcohol consumption is growing in the country? All right, so let me know in the comments how this piece of legislation is going to help you, if it will help you, or any ideas of how you're going to use this legislation going forward. That being said, I know I had a long list of disadvantages, but there are a couple of advantages as well. And one of the first advantages, and really the biggest advantages, and it can outweigh most of the disadvantages I spoke about, and that is freedom and liberty. You have the freedom to choose how to use your own money at whichever time period. However, freedom and liberty exists within boundaries. And in this context, you are going to have to create those boundaries for yourself. Funds shouldn't be used for Christmas or wedding shopping or buying consumer goods, but for real emergencies, life and death medical care, anything major to do with your primary residence if you fall behind. But the key is to apply financial literacy to your decision making. And you're here, and it's great. And I'm really excited for you. Watch a lot more of our content. Also engage with other South African content creators on finance as well to start improving how you understand South African financial systems. The second advantage is cash flow. And the thing with cash flow, and any kind of cash flow, not just a withdrawal from the savings portion of your retirement, is to always consider inflation and taxation into any income that you get. Understand how inflation affects this cash flow now and in the future. And also understand how tax affects your cash flow. Okay, so you got to understand how the withdrawal of savings compounded by inflation will erode future retirement cash flow. The loss of tax-free growth, all of that, you got to take that into your decision making before you withdraw. Any amounts withdrawn from the savings pot will be included in your taxable income for that tax year and taxed at your marginal tax rate. You know, when you see an amount like 2,000 Rand in the legislation, it really gives you an indication that low income earners are being targeted by this piece of legislation. And you know, that's fair, because that's where the need is the greatest. However, unfortunately, that also is the place where financial literacy is the lowest. And I really feel when or if this piece of legislation comes about, that financial education needs to be prioritized. And it's not just product training that's needed, where the individual understands the nitty-gritties and the ins and outs of how this works, but also to understand the impact of tax, understand the impact of inflation, to make a thorough, comprehensive decision of whether they should withdraw or not, and the impact this withdrawal would make on their future retirement income. All right, that's it for me. Thanks for joining me today. We'll talk to you next week.